So Bio-Techne just reported their Q3 earnings. And if you're an investor just glancing at your terminal, you saw a revenue decline.
Right, a slight drop.
Yeah, and they missed consensus EPS estimates. Plus, two of their absolute largest clients
Yeah.
just like abruptly halted their material orders.
Which sounds terrifying on the surface.
Exactly. I mean, your immediate instinct is probably to just hit the sell button right then and
Oh,
there.
absolutely.
But, if you look closely at the Bio-Techne Q3 2026 earnings report, and we went through the accompanying call transcript from May 6th, this apparent stumble is actually hiding something huge.
It really is. It's hiding one of the most explosive growth indicators in modern medicine right now.
Okay, let's unpack this.
Yeah.
Because reading a life sciences earnings report, it requires an entirely different lens
Yeah.
than, say, looking at a standard tech or retail stock.
Yeah, completely different. I mean, Wall Street operates on these really binary scoreboards, right? Like a miss is a miss to them.
Right, the numbers are just red or green.
Exactly. But the life sciences sector requires reading the underlying structural shifts. This specific report actually functions as a highly accurate crystal ball for the whole sector.
Because the sector is going through a massive transition right now.
It is. What those surface numbers are obscuring is this profound tug of war. You have a booming late-stage pharmaceutical engine on one side, and then a heavily constrained early-stage discovery environment on the other.
And whether you are actively managing a biotech portfolio, or maybe you're developing software for the life sciences sector, or honestly just insanely curious about how the next generation of targeted therapies will be made, you really need to understand the mechanics of this specific quarter.
Yeah, because Bio-Techne's performance is, it's basically a bellwether.
Right. It illustrates in real time how artificial intelligence and, fundamentally restructured venture capital models are actually altering the physical supply chain of drug development.
The physical reality of it, yeah.
So let's just dissect that initial revenue decline. Q3 revenue landed at $311.42 million.
Which is a 2% decline year over year.
Right. And adjusted EPS was 53 cents, missing consensus by 2 cents. So on paper, it looks like a contraction.
It does. But to understand the reality of that 2% decline, you really have to break down what management identified as a 400 basis point headwind during the quarter.
Okay, so a 4% drag, essentially.
Yeah. And the first piece of that is straightforward logistics. 1% of that headwind was simply the timing of a large OEM commercial supply order.
Right, so just a calendar thing.
Exactly. It historically lands in the third quarter, but due to a calendar quirk, it was fulfilled early in Q2.
A scheduling anomaly. I mean, that happens all the time with B2B supply chains, right?
All the time. But the other 3%, that's the structural indicator you mentioned earlier.
Okay, lay that out for us.
So that revenue gap basically materialized because two of Bio-Techne's absolute largest cell therapy customers received FDA Fast Track designation for their clinical programs.
Wait, I need to stop you there. Receiving FDA Fast Track designation is like the ultimate goal for a clinical stage biotech company, right?
Yeah. It's the dream scenario.
Right. It means their data is overwhelmingly positive, and the FDA actually wants to accelerate the approval process.
Correct.
So how does a client achieving their ultimate success result in Bio-Techne losing 3% of their quarterly revenue? I mean, that sounds like the client just fired them.
It really seems counterintuitive, I know. But it all comes down to the mechanics of how clinical trials actually consume physical materials.
Walk us through that.
Well, when a cell therapy company is running a standard, prolonged phase 2 or phase 3 trial, they are continuously ordering just a steady drip of GMP reagents from suppliers like Bio-Techne.
GMP meaning good manufacturing practice, right?
Right, the clinical grade stuff. They need constant functional testing, constant validation for, every incremental patient enrolled in the trial.
They're running hundreds of iterative experiments over a span of months or even years.
And consuming those reagents every single day. But when the FDA looks at the interim data and grants fast track status, the regulatory pathway just compresses.
Oh, I see.
Yeah, the client suddenly doesn't need to run the next 6 months of marginal exploratory testing. They freeze their clinical protocol and just immediately pivot all of their internal resources toward preparing for commercial scale-up.
And the daily region orders pause.
Exactly, because the exploratory phase is abruptly over.
So it is like a construction crew that finishes framing a building 3 months ahead of schedule.
That is a perfect analogy, actually.
The supplier of the raw lumber sees a sudden drop in orders today, Not because they lost the contract, but because the crew is just waiting on the inspectors to clear them for the drywall phase. The project is actually incredibly healthy.
That is the exact dynamic. The pause in purchasing is a transition period. Moving to commercialization faster means these clients are transitioning out of limited testing pools and into mass production.
Right, they aren't just testing the drug on 50 trial participants anymore.
Exactly. They have to prepare their facilities to manufacture it for thousands of commercial patients.
And, the underlying data in the report completely supports this. If you isolate those two fast-track clients and just remove them from the equation, the rest of Bio-Techne's GMP protein portfolio grew by 50% year over year.
Which is staggering underlying demand.
It is.
So,
Furthermore, if you exclude the OEM calendar quirk and those fast-track anomalies, the company's underlying organic revenue actually grew by 2%.
right. And the financial foundation is just robust. During this supposedly down quarter, they generated $86.7 million in operating cash flow.
Wow.
Yeah, and they returned $12.5 million to shareholders in dividends and maintained an adjusted operating margin of 34.2%.
So they're highly profitable.
Very. And they're actively positioning their capital to capture the massive manufacturing scale-up that will inevitably follow these fast-track approvals.
Oh, you're talking about their stake in Wilson Wolf.
Yes, exactly.
Because they hold a strategic 20% position in that company, with a stated plan to fully acquire the remaining 80% by, I think, the end of calendar year 2027.
Right. And Wilson Wolf manufactures the G-Rex bioreactor, which has basically become the market-leading platform for single-use bioreactors in the cell therapy space.
And single-use technology is critical for commercial scale-out, right?
Oh, absolutely. It eliminates the downtime, the really rigorous cleaning, and all those contamination risks associated with legacy stainless steel bioreactors.
Right.
And Wilson Wolf is currently generating 70% EBITDA margins.
Wait, 70%? That's incredible.
Yeah, and they're maintaining low double-digit growth even in a constrained macro environment. So Bio-Techne's planned acquisition is just timed perfectly to capture that commercial production ramp-up when those paused cell therapy clients finally hit the market.
So the headline miss is essentially just a slingshot being pulled back.
That's a great way to put it.
But we really need to address the other side of this tug of war, because the optics there are genuinely confusing.
You mean the early-stage biotech stuff?
Yeah, late-stage cell therapy is accelerating, right? Large pharma just posted its 6th consecutive quarter of double-digit growth. Yet, Bio-Techne's core Regents business, specifically serving emerging biotechs, declined by high single digits.
Right, which seems completely backwards.
It contradicts all the broader macroeconomic data we are seeing in the sources. Broad biotech funding actually jumped by 90% in Q2, and then surged another 50% in Q3.
The venture capital is clearly entering the ecosystem.
Exactly. The money is there. So why isn't Bio-Techne capturing it?
Well, you are identifying the classic macroeconomic lag that defines the life sciences supply chain.
Okay, the lag.
Yeah. Historically, it takes 2 to 3 full quarters for secured venture capital funding to translate into the actual purchasing of laboratory equipment and biological reagents.
Okay, walk me through the timeline of that lag.
Yeah.
Because to an outsider, it feels like, if a startup closes a $50 million Series B in January, they should be ordering supplies in February.
Right, you'd think so. But the reality of biotech operations is just far slower. When the term sheet is signed and the funds finally clear the bank, the company undergoes this massive operational shift.
Like what?
Well, they spend the first 3 months just finalizing real estate leases and building out specialized clean rooms.
Oh, true. You can't just work in a standard office.
Exactly. Then they spend the next 3 months recruiting principal investigators, hiring postdocs, and locking in their strategic experimental pipeline based on the new mandate from their board.
Right. That takes time.
It is only after the facilities are functional and the personnel are actually in place, which is often 6 to 9 months later, that the procurement department actually begins issuing purchase orders for complex proteins, antibodies, and, spatial biology platforms.
But are we entirely sure this is just a time delay? I mean, as an investor, you have to maintain a healthy skepticism.
Oh, for sure.
Couldn't these newly funded startups simply be taking their venture capital and just pivoting to a cheaper competitor?
That's a fair question, and the analysts on the earnings call actually applied that exact pressure to management.
What did they say?
Well, a deep dive into the funding distribution completely disproves that market share loss theory. You have to look at where the venture capital is being deployed across the clinical pipeline.
Okay.
Currently, 82% of all biotech funding is locked into late-stage clinical development.
Meaning phase I through phase 3 trials.
Exactly.
So that is a profound shift in risk appetite.
It's a massive structural shift. Institutional investors are prioritizing safer, de-risked late-stage assets. They want a clear line of sight to commercial approval.
They want a sure thing.
Exactly. Meanwhile, funding for early-stage discovery, the high-risk exploratory phase where scientists are searching for entirely novel drug targets, that has just plummeted.
Right. The report showed it dropped from 25% of the total funding pool down to just 18%.
Yep. And Bio-Techne's core Regent portfolio is heavily leveraged to that early-stage discovery phase.
Ah, I see.
So it's not that a competitor is stealing the accounts. It's that the specific tier of scientists who rely on those exploratory regions simply haven't received their capital yet. The broader industry is basically just hiding in the safety of phase 3.
Wow. So the early stage innovators are completely cash-starved right now.
They are. There is a small stabilizing factor in the public sector, however.
Oh, right. The academic markets?
Yeah, U.S. academic markets have stabilized into low single-digit growth, and that was supported by a 1% increase in the broader NIH budget.
So the academic foundation is holding, but the commercial early stage pipeline remains super tight.
Extremely tight.
Well, if early stage discovery is operating under such severe capital constraints, the teams that do actually have funding cannot afford to run low-yield iterative experiments.
No, they can't afford the trial and error anymore.
Exactly. They need platforms that guarantee comprehensive, high-fidelity results on the very first attempt. And this dynamic naturally forces the industry to pivot toward data-rich platforms.
Which brings us to arguably the most transformative section of this entire earnings report.
Yes, the explosive breakout of spatial biology and its intersection with artificial intelligence.
Right. Because the growth metrics in the segment are completely decoupled from the struggles of that core reagents business we were just talking about.
Oh, totally.
Bio-Techne's spatial biology division actually grew in the mid-teens, driven almost entirely by their COMET platform, which posted over 65% growth.
Wait, 65%?
Yeah. They are sitting on a record backlog of orders, and they just completed their first commercial installation in China.
And China was a massive bright spot across the board for them, achieving its fourth consecutive quarter of positive organic growth.
Which is huge in the current climate.
Definitely. That was driven heavily by demand for antibody-drug conjugates, cell therapy manufacturing, and autoimmune research. Plus, their proteomic analysis franchise also grew mid-single digits.
Led by the Ella benchtop immunoassay platform, right?
Right, which grew in the upper teens. That was fueled by a 50% three-year compound annual growth rate in neurodegeneration assays.
Wow.
Plus, Ella just received CE-IVD marking in Europe, so that upgrades it from just a research tool to a fully approved clinical diagnostic instrument.
Which completely changes its market potential. And the reason Comet and Ella are commanding such aggressive growth in a tight market really comes down to the quality of the data they produce.
How so?
Well, traditional bulk sequencing is kind of like putting an entire tissue sample into a blender and reading the average protein levels.
Okay, a blender.
Yeah, it tells you what is there, but it completely distorts the architecture. You lose the context. Spatial biology, on the other hand, keeps the tissue completely intact.
Oh, wow.
Yeah, it maps exactly where every individual protein lives, how they interact with each other, and their precise location relative to a tumor cell or an immune cell.
Okay, and this is where we really have to connect the hardware to the AI revolution, because building a biological AI model requires immense volumes of training data.
The models are starving for good data.
Exactly. Feeding an AI, a traditional bulk sequencing readout, is essentially like giving it a list of addresses. The AI knows who lives in the city, but it has absolutely no idea how the neighborhoods are actually structured.
That is a brilliant way to frame it.
Right. Spatial biology gives the AI a complete high-resolution topographical map. It provides the crucial context of the biological microenvironment.
And in the current life sciences landscape, high-fidelity spatial data is the most valuable commodity available, period.
And Bio-Techne possesses a profound competitive moat here, backed by literally 50 years of proprietary structural data.
And management explicitly highlighted how this data is already being deployed out in the real world. Providence and Microsoft have actually collaborated to build an AI framework called GigaTime.
GigaTime.
Yeah.
That uses the exact spatial data generated by Bio-Techne's Comet platform, right?
Yeah.
To convert standard 2D pathology images into fully realized navigable 3D virtual tissues. The AI just extrapolates the three-dimensional architecture of a tumor microenvironment simply by analyzing the high-fidelity spatial map provided by the hardware.
Which is mind-blowing. And Bio-Techne is aggressively deploying AI internally as
Oh,
well.
really?
Yeah, they are utilizing machine learning models trained on their half-century of proprietary protein data to design novel, highly stable proteins that literally do not exist in nature.
So they're inventing new proteins.
Exactly. They are engineering recombinant proteins with optimized heat stability and enhanced bioactivity specifically tailored for complex manufacturing environments.
Okay, but how does a computational algorithm drive quarterly revenue
Yeah.
for a company that manufactures physical biological supplies? I mean, an AI model doesn't have a procurement budget to buy a bioreactor.
No, it doesn't, but it is the ultimate downstream validation loop.
Okay, explain that.
Well, AI models are exceptionally good at accelerating the earliest stages of drug discovery. An algorithm can analyze that topographical spatial map and generate thousands of novel hypotheses about potential drug targets literally overnight.
Just massive output.
Right. But a computational model is ultimately just a statistical prediction.
It's just math.
Exactly. Every single hypothesis generated in a server farm requires physical, biological validation in a real laboratory.
Ah, you still have to prove the algorithm is actually right by testing it in a physical petri dish with living cells.
Exactly that. If an AI platform identifies, say, 100 potential new proteins involved in neurodegeneration, the researchers suddenly need to purchase highly specific antibodies, functional assays, and complex recombinant proteins to test all 100 of those computational predictions.
Oh, wow.
Yeah, AI acts as an unprecedented downstream demand driver. The faster the algorithms generate targets, the more physical reagents are consumed to validate them.
Just an aggressive multiplier effect on their core business.
Exactly.
And Bio-Techne is actively restructuring their corporate identity to capture a client from that very first AI-generated hypothesis all the way through to commercial manufacturing.
Right, the brand realignment.
Yeah, they recently announced the strategic brand realignment, streamlining their portfolio from 10 kind of overlapping legacy brands down to just 3 core pillars: R&D systems, Bio-Techne Spatial, and Bio-Techne Diagnostics.
Which is a deliberate operational strategy to just simplify the customer procurement journey.
So they stay in the ecosystem.
Exactly. If a researcher discovers a novel target using the Comet platform under Bio-Techne Spatial, the corporate structure is now designed to seamlessly transition them to R&D systems for their validation regions, and eventually to Bio-Techne Diagnostics as their therapy moves toward clinical application.
So the goal is to keep the compounding value of that research entirely within the Bio-Techne ecosystem.
Yeah, exactly.
So when you synthesize the entirety of this earnings report, the narrative shifts completely. You start with what looks like a surface-level revenue decline and a really concerning pause in orders from major clients. Right.
But beneath that, you find a 50% growth rate in core GMP proteins, a 2 to 3-quarter macroeconomic lag acting as a coiled spring for future revenue, and a spatial biology division expanding at 65% to feed the insatiable data demands of artificial intelligence.
It's a completely different picture. And the ultimate takeaway for anyone analyzing this sector is that the true health of a life sciences company is rarely found in the headline earnings miss.
It's just noise.
Right. It is found by mapping the underlying currents of where the institutional capital is preparing to flow.
And right now, the capital is clearly accumulating in late-stage commercial manufacturing and AI-driven spatial data.
Exactly. The temporary dip in early-stage region sales is simply the friction of an industry caught in a massive transitional phase.
It's the difference between looking at the surface of the ocean and thinking the tide is going out, while completely ignoring the structural tectonic shifts happening on the seafloor.
So we've covered the mechanics of the fast-track illusion, the venture capital lag, and the integration of spatial data with AI. But as we wrap up, I want to leave you with a final thought to ponder a logical extension of everything we've unpacked today.
And this is something that really fundamentally shifts how we view the future of this space. If artificial intelligence continues to accelerate biological target discovery at this exponential rate, basically expanding the number of viable drug programs from dozens to thousands practically overnight, the fundamental bottleneck in modern medicine is going to violently shift.
Because for the past 50 years, the bottleneck has always been the immense difficulty of just inventing the cure.
The struggle of discovery, exactly. But if AI actually solves the discovery problem, the bottleneck moves entirely to the physical realm.
The real world.
Right. The constraint will no longer be computing power or algorithmic accuracy. It will be whether the global supply chain can physically manufacture the GMP-grade proteins, the specialized reagents, and the single-use bioreactors fast enough to test and produce these therapies in the real world.
Wow. So the real question is the global life sciences infrastructure truly prepared for an AI-induced drug discovery traffic jam?
Exactly.
A reality where we have vastly more computational cures than we have physical lab space to validate them. It all begins with looking past the superficial numbers and understanding the actual mechanics of the supply chain. Thank you for joining us on this deep dive. Keep questioning the headlines, and we will catch you next time.